There's a number sitting inside your super balance right now that your fund has never highlighted for you, that your employer never mentioned, and that most financial conversations never get to until it's too late to do anything about it. It's called your taxable component. And if you have adult children who aren't financially dependent on you, that number is going to determine how much of your super the ATO collects the week you die. On a $500,000 balance built the ordinary Australian way, employer contributions across a working life, a bit of salary sacrifice along the way, decades of compounding quietly in the background, your adult children could be handing the tax office somewhere in the order of $85,000 on top of their grief. Not because you structured anything poorly, not because you did a single thing wrong, because the superannuation system treats the taxable component of your death benefit in a way that most Australians never discover until the window to fix it has already closed. I'm going to explain exactly how that works today, the mechanism, the maths, the deadline, and what can still be done depending on where you're sitting right now. My name is Graham Whitfield. I spent 34 years as a financial planner working with ordinary Australian families, self-funded retirees, small business owners, people who'd done everything right and simply never been told about this particular corner of the system. I wound back my practice 3 years ago. This channel exists because I watched the same conversation happen too many times. The one where someone finds out about the re-contribution strategy at 76, and you have to sit across from them and explain that the window closed last year. That conversation is avoidable. That's the whole point of being here. Quick note before we go further. If you've already run a re-contribution strategy, you know your component split and you're across the age 75 contribution rules, this one isn't for you. Come back for the next video. But in my experience, the number of ordinary Australians who've genuinely had that conversation with someone who explained it properly and then actually acted on it is much, much smaller than it should be. Let's fix that. Australia got rid of inheritance tax in 1979. Death duties, gone. When you die, your home passes to your estate and eventually to your beneficiaries without the ATO taking a cut of the transfer. Your share portfolio, your bank accounts, your investment property, same thing. The assets change hands. No tax on the transfer itself. Most Australians know that, or at least assume it, and they assume super works the same way. That assumption is expensive. Super is not a standard asset. It sits outside your estate entirely. It doesn't flow through your will automatically. It gets paid to whoever your fund is directed to pay, either through a binding death benefit nomination you've made, or at the discretion of the fund trustee if you haven't. That distinction between those two options matters enormously, and we'll come back to it. But for now, the critical point is this. When super lands in the hands of an adult child who isn't genuinely financially dependent on you at the time of your death, a substantial portion of it is taxed, not at some obscure fringe rate, at 17%. And most people have never looked at why. Your super balance has two components. They sit inside the same account, they grow together, they look like one number on your statement. But they are treated completely differently when they become a death benefit. The first component is called the tax-free component. This is broadly made up of personal contributions you made from your own after-tax money and didn't claim a tax deduction on. Non-concessional contributions, in the jargon. The second component is called the taxable component. This is everything else: employer contributions, salary sacrifice, any personal contributions you did claim a deduction for. And critically, all the investment earnings that have accumulated on top of those contributions across your entire membership. For most Australians who built their super through employment over a standard working life, the overwhelming majority of their balance sits in the taxable component. The tax-free slice is often quite modest by comparison. This isn't a sign of bad planning. It's the natural result of how the system was designed to work. Your employer's contributions went in before tax. The fund earned returns before tax. The taxable component grew because that's what it was supposed to do. Here's why this matters. While you're alive and over 60, withdrawals from a taxed fund are completely tax-free to you regardless of this split. So you've had zero reason to ever check it. It doesn't appear in bold on your annual statement. It doesn't come up when your employer processes your super. There's no moment where someone sits you down and says, by the way, here's what this number means for your kids. It becomes relevant exactly once. When you die. When your super is paid as a lump sum death benefit to a non-dependent adult child, and the legal definition of financially dependent is stricter than most families assume. Helping your daughter with rent or covering your son's car repayments does not meet the test. The taxable component of that payment is taxed at 15%, plus the 2% Medicare levy if it's paid directly from the fund. That's 17% on the taxable component. If the death benefit is paid to your estate first and then passes through your will to your children, the Medicare levy generally doesn't apply. That brings the effective rate down to 15% on the taxable component. That distinction, estate versus direct payment, is worth discussing with an advisor because it can represent real money on a large balance. Let me put real numbers against this because abstract percentages don't land the same way as dollars. On an $800,000 super balance where 90% is taxable component, and that proportion is entirely ordinary for someone who built their balance through employment, the taxable component is $720,000. At 17%, the tax on a direct fund payment is just over $122,000. At 15% via the estate, it's $108,000. That's money your children lose, not because you failed them, not because you made mistakes, but because the split inside your balance was never restructured, and the provision that allows you to restructure it has an age limit. There is a legitimate ATO-acknowledged provision in the superannuation legislation that allows you to change the composition of your balance. It's called the Re-contribution Strategy. It is not aggressive tax planning. It is not a grey area. The ATO publishes guidance on it. It is built into the architecture of the system. Here is the mechanism in plain terms. Once you've met a condition of release, meaning you can legally access your super, which from age 60 with retirement, or from age 65 regardless, you withdraw an amount from your fund. From age 60, that withdrawal is completely tax-free to you. You're over 60, you're drawing from a taxed fund, you pay nothing on the way out. You then take that same money and contribute it back into super as a non-concessional contribution, an after-tax personal contribution. Because it goes back into the fund as after-tax money, it enters as tax-free component. You have just converted taxable component into tax-free component. And when the death tax calculation runs on whatever taxable component remains at the time of your death, it runs on a smaller number than it would have without this step. In the 2025 to 26 financial year, you can contribute up to $120,000 per year in non-concessional contributions. If your total super balance at the prior 30th of June sat below $1.76 million, you can use what's called the bring forward rule, pulling up to 3 years' worth of caps into a single contribution. That's up to $360,000 in 1 year. If your balance sits at $2 million or above at the prior 30th of June, the non-concessional cap reduces to nil for that year, and the strategy isn't available to you in that period. One technical point worth being clear on. You can't choose to withdraw only the taxable component. When you take money out of super, it comes out in the same proportions as your overall balance. If your fund is 85% taxable and 15% tax-free, every dollar you withdraw carries that same split. The strategy still works. You're converting that proportion with every cycle. But it means the numbers need to be modeled carefully before you act. Many people open a second super account specifically for the recontributed money to keep the new tax-free component clean and easy to trace. In an SMSF, that's straightforward. In a retail or industry fund, it typically means opening a second account either with the same fund or a different provider. Non-concessional contributions, the mechanism that makes the recontribution strategy work, must be received by your fund no later than 28 days after the end of the month in which you turn 75. That is the rule directly from the ATO. After that, the window closes. Not partially, not with exceptions for people who didn't know, not with discretion for estate planning purposes. The fund cannot accept the contribution. The strategy in its full form is no longer available, which means if you're 72 or 73 or 74 right now, you may have 1 or 2 annual contribution rounds remaining. You may have one final opportunity to use the bring forward rule if you haven't recently triggered it. And the window is closing whether or not you know it's closing. I'm not saying that to create urgency for its own sake. I'm saying it because the maths of the age limit is exactly that simple. There's another layer that catches people, and it's the one that produces the most genuine frustration when it comes up late. When you convert your accumulation super into an account-based pension, which is the standard structure most retirees move into when they stop working, the proportion of tax-free and taxable component inside that pension account is fixed from the day you commence it, locked in, does not adjust as the market moves, does not change as you draw down, cannot be altered retrospectively. If you started your pension at 65 with a balance that was 88% taxable component, your pension account will be 88% taxable component the day you die, even if you live another 25 years. A new non-concessional contribution under a re-contribution strategy would need to go into a separate new accumulation account. The existing pension split is done. I watched this catch more than a few families who had genuinely done everything else properly. They'd moved into pension phase at the right time, set up the income stream correctly, ticked every box they knew existed, and then encountered the re-contribution strategy for the first time at 74, with a pension account that couldn't be restructured and one narrow window left on a small accumulation balance. That is a hard conversation to have across a table from someone. If you're reading your situation into any of this, here's where to start. 3 steps in order. First, find your component split today. Log into MyGov, link through to the ATO's online services, and look at your super information. For the specific taxable and tax-free breakdown, contact your super fund directly. Most can give you this over the phone or through your member portal. The exact question to ask is, what is the current split between my taxable component and my tax-free component? Write it down. That number is the foundation of every conversation that follows. Second, map your position against the 75 deadline. If you're in your early 60 seconds, you have meaningful time to run the strategy in stages and let the bring forward rule do the heavy lifting across multiple years. If you're 73 or 74, the bring forward window may be your last significant opportunity to move serious money across. Knowing that changes how urgent the next conversation needs to be. Third, take the question to a registered financial advisor. Specifically ask, given my current age, my component split, my total super balance, and whether I'm in pension or accumulation phase, what's still available to me under a re-contribution strategy, and does the maths make sense for my situation? A good advisor will model the before and after on your actual numbers. In many cases, the tax saving your children would receive is a substantial multiple of the advice fee. That's not a guarantee, because everyone's position is different, but it's a genuine reason to have the conversation rather than defer it. If your spouse is younger and under 75, there may be additional strategies available around contributions to their account that are worth exploring as part of the same conversation. Spousal strategies don't replace a re-contribution approach, but they can complement it, and a younger spouse changes the window considerably. The thread that runs through all of this is uncomfortable, but worth naming. The wealthier end of the market tends to have advisors who identified this issue early, built a re-contribution strategy into the retirement structure from the beginning, and dealt with it long before it became urgent. The ordinary self-funded retiree, the person who worked hard, contributed consistently, done everything right, tends to find out about it late or not at all. The law is identical for both people. The provision is available to both people. The deadline applies to both people. The difference is entirely about who was told about it and when. The super death tax isn't a trap the ATO designed maliciously. It's the default outcome when nobody intervenes. The re-contribution strategy isn't a sophisticated loophole available only to people with SMSFs and expensive accountants. It's in the same legislation sitting there for every Australian, available right up until that 75th birthday. That's the gap. A legitimate provision, a hard deadline, and decades of that provision not being explained plainly to the people it was most designed to help. If this is the first time you've heard any of this, I'm glad you're hearing it now rather than later. The next step belongs to you. This is general information based on my years in practice. I'm no longer a licensed financial advisor, and your specific situation, your balance, your age, your family structure, your fund, deserves someone who can run the actual numbers with you. Please use this as the starting point for that conversation, not the substitute for it.